Here's a number that's going to blow your mind. UK adults hold just 8% of their wealth in investments outside of their pension. That is the lowest in the entire G7. Meanwhile, Americans hold 33% in investments. That is 4 times the amount of us Brits. We are talking £3.5 trillion that is sat in cash or property that could be building us a fortune. Look at this chart. This is where UK investors are keeping their money outside of their pensions. 50% in property, 15% in cash, and only 8% in investments. Compare that to Americans. 26% property, 33% in investments. We've created a culture where buying a house is seen as smart in the UK, whereas buying shares is seen as gambling. This data comes from Aberdeen's 2025 analysis of the G7, and it reveals some shocking stats around British psychology. I'm going to prove this to you using the Nobel Prize winning research of behavioural economics. Daniel Kahneman is a big name when it comes to behavioural economics. He spent decades studying how people make financial decisions. And what he found will shock you. Your brain is literally wired to keep you poor. And it's not your fault, it's evolution. In the next 18 minutes, I'm going to show you the 3 psychological traps that are keeping you poor. Why your brain is literally wired to avoid wealth. And the simple mental shifts that you can take to rewire your relationship with money. Let's start with the most dangerous trap of all. Before we dive into the psychology, you need to understand just how bad this problem is. According to 2025 data from Statista, the largest group of UK investors come from Gen Z, but even they represent a minority of the entire UK population. The Investment Association found that only 39% of UK adults do any form of investment. That means that 61% of the entire country is missing out on wealth building. Meanwhile, the Office for National Statistics show our UK household savings have dropped 10.9% in Q1 of 2025 alone. That is down from 12% just 1 quarter before. The Bank of England has also reported that deposit rates have been falling consistently since mid-2024. So ultimately, we're saving less money and earning less on what we have saved. But here's where it gets really embarrassing. Aberdeen's analysis of the G7 nations shows the UK dead last in retail equity exposure. We're not just behind America, we're behind Canada, Germany, France, Italy, and Japan. Aberdeen's report describes the UK as streets behind to explain our investment culture. That's not hyperbole, that is institutional research. So where is all of our money going? Property and cash? UK adults hold 50% of their non-pension wealth in property. That's double what American is holding at 26%. We also hold 15% in cash. That is the 3rd highest in the G7. We've built an entire culture around getting on the property ladder, but we've completely ignored the investment ladder. And there's a psychological reason for this. Your brain is literally playing tricks on you. Let me show you how. In the 1970s, Daniel Kahneman and Amos Tversky made a discovery that would change economics forever. They found that humans don't make rational decisions. Traditional economics assumed that people were logical, but behavioral economics proved that they're not. This work was so groundbreaking that Kahneman won the Nobel Prize in Economics in 2002. His research has been cited over 8,000 times in academic literature, and it explains why you're not investing. Let me prove this to you with a simple test. Would you rather £100 guaranteed or £200 with a 50% chance of winning that? Most people chose the £100 guaranteed. Now, different scenario. Would you rather lose £100 for certain or have a 50% chance of losing £200? Now, most people chose the gamble. This is loss aversion in action. Kahneman's research shows us that we feel losses approximately 2.2 times more intensely than an equivalent gain. This is why stock market investing feels so terrifying. You see the daily fluctuations, and with this, the potential losses. But you're missing out on the long-term wealth creation. Aberdeen's 2025 research shows that UK adults have a low risk tolerance. They prefer a 4.8% savings account over 7 to 8% upside gain in the stock market. Over 10 years, £10,000 at 4.8% turns into £16,000. The same £10,000 invested in the stock market at 8% becomes over £21,500. That's £5,500 you're losing to loss aversion. The second trap is called present bias. It's why you choose immediate rewards over future benefits. Your brain is hardwired to reward instant gratification. Buying something today feels good right now. Investing feels like giving up money for a future vague benefit. This explains why UK household savings rates keeps on falling, from 12% in Q4 of 2024 down to 10.9% at the end of Q1 2025. We're choosing consumption over investment. Neuroscience shows that immediate rewards triggers our limbic system, aka our emotional brain. Future rewards activates the prefrontal cortex, which is our rational brain. Guess which one usually wins? The third trap is the most dangerous, and that is called herd mentality. Look at your social media feed right now. How many posts do you see about buying cars, clothes, or booking holidays? Now, how many posts do you see, other than mine, about buying index funds? Research shows that investment behavior is heavily influenced by your peer group. If your friends don't invest, you probably won't either. This creates devastating market timing. During bull markets, everybody, because of this, is investing right at the top. During crashes, everybody is selling right at the bottom. It's the exact opposite of wealth building. And in the UK, we've created a herd mentality around UK property. Everybody is talking about getting on the ladder and getting their first home. But nobody is talking about getting on the investment ladder and getting started. Breaking free from the herd mentality is the first step to building wealth. But how do you actually do it? That's what I'm going to show you next. Before I give you the solutions, you need to understand something fundamental. Wealthy people don't have different brains. They just think about money differently. Morgan Housel, the author of The Psychology of Money, puts it perfectly. The car's not bought, the clothes not purchased, the dividends reinvested. Most people think wealth is about what you can buy. Wealthy people know that wealth is about what you do not buy. They see money as a tool to buy time and assets, not things. Every pound that is spent on consumption is a pound that isn't compounded. Every pound that is invested is a pound that works for you forever. The first solution is automation. Remember, loss aversion makes investing feel painful, so remove the emotion entirely. Set up a direct debit into an index fund or an investment ISA. Treat investing more like you have a bill to pay each month. Start small if you need to, £50 a month, £100 a month. Getting started is the key here. Even £100 a month at 8% per annum return becomes over £146,000 in 20 years. This is a behavioural hack. You're using automation to bypass your brain's resistance. And once it's automated, you stop thinking about it. No daily decisions, no reactions to daily market volatility. Just consistent, systematic wealth building. The second solution is about reframing risk. Your brain thinks cash is safe and stocks are risky. But inflation is making cash the riskiest investment of them all. At just 3% inflation, your buying power on cash is halved every 23 years. Yes, your stocks are volatile in the short term, but they're the safest way to preserve your purchasing power in the long term. Over any 20-year period, the stock market hasn't lost any money. The real risk isn't market volatility. The risk is not investing at all. Every year you wait is costing you in compound interest, and you're never going to get it back. Starting at 25 in comparison to 35 can cost you hundreds of thousands of pounds in your retirement wealth. The third solution is the most powerful, changing your identity. Stop thinking of yourself as someone who might invest in the markets one day. Start thinking of yourself as an investor who's starting to build your investment portfolio. Surround yourself with investment content. Read financial news, listen to investment podcasts, find friends who invest, and join investment communities online. We have one ourselves, and if you're interested in registering for my next wealth creation conference, then make sure you fill out the type form. I'm also going to be launching my book of 100 ways to become wealthy. So if you're interested, make sure you register that interest. Your behavior follows your identity. If you see yourself as an investor, you're going to act like one. Start celebrating investment milestones and not just spending milestones. Train your brain to think in decades and not in days. Einstein allegedly called compound interest the eighth wonder of the world. Those who understand earn it, those who don't pay it. You don't need thousands to start, you only need consistency. Try to maximize your £20,000 ISA allowance. That's over £1,667 per month, tax-free. Start with a simple global index fund. Low fees, instant diversification, and no stock picking required. Platforms like Vanguard, iShares, or Hargreaves Lansdown make this very simple. Compare fees too between the platforms, because these will also compound. And remember, the financial news is always going to try to scare you. Market crash, economic uncertainty, or it's time to sell. Every crash in history has been followed by a steep recovery, and every crisis has been one of the biggest buying opportunities in the markets. Use market volatility to your benefit by utilizing dollar cost averaging. When prices fall, you are buying more shares for the same cost. Emotional investors are buying high and following the crowd and selling low. Systematic investors are buying consistently, month on month, by direct debit and building long-term wealth. As you build confidence, you can start to optimize your portfolio. Adjust your asset allocation based on your age and your future goals. Maximize your tax efficiency through your ISA allowance and your pensions. Rebalance annually to maintain your target allocation. And remember to keep learning. The best time to start was 20 years ago, and the second best time to get started is today. You now have a choice. You can keep on following the herd, keep 50% in property, 15% in cash, and 8% in the financial markets. Stay part of the 61% who don't actively invest in the markets. Or you can choose the path of the wealthy. Automate your investments, reframe your risks, and build your investor identity. The difference isn't just money, it's freedom. Remember that this isn't about math, it's about psychology. Nobel Prize winning research shows that your brain is wired for investment failure. But behavioral economics also shows you how you can rewire it. Every wealthy person has overcome the same mental investment barriers that you're facing today. The only difference is they started. And let's put this together. Your homework is very simple. Open an investment account this week. Set up a direct debit of £50 to £100 per month. It's not about the amount, it's about breaking the psychological barrier. Your future self is going to thank you. Because the psychology of money isn't about understanding why you're poor, it's about understanding how to build your wealth. It's about choosing to get rich instead. If you've enjoyed this video, then please do follow for more, hit that like and subscribe. I'm going to be demonstrating exactly how you can build your wealth on a daily, monthly and yearly basis.